Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Monday. It's February 27th. We got one more day, and February is behind us. How could it be? My God, it just seems like the year started yesterday. I hope everyone had a nice, relaxing weekend, got some rest, and is ready for the new week. And by the way, if you're liking these videos, subscribe to our YouTube Wealth Press channel. Like these videos and comment below these videos. I actually respond to you, and I'll tell you what's going on and respond to your answers specifically before the next day. And if you have more questions, send me an email, support@marketgeeks.com. Now let's get into it right now. So as you can see here, the NASDAQ is up about 70 points. Dow futures are up 136 points. And we're starting off a very, very interesting week. So let me kind of put the puzzle together for you. It looks like we bottomed out in the short term here. Now, if we break this and if we really go down to, say, 320, there's a good chance we'll go lower. But for now, it looks like this level is going to hold, and it looks like we're going to go back within this channel. Now, remember, this channel has been around now since November, and it does look like it's reached the bottom. Now, I was waiting for algos to take it down one more notch. I haven't seen that yet. And the interesting part today is we've got earnings on the retail sector, and we all know how impactful earnings on the retail sector could be. So just to give you some idea, tomorrow, we've got Target. They're looking at 56% year over year. Revenue down barely. It'll be very interesting to see how they meet their expectations. We got Zoom tomorrow. We got Workday tomorrow. That's actually today. I'm going backwards now. So yeah, Zoom is today, Workday is today, Universal Health is today. Let's see here. Lee Auto is today, Lending Tree is today, Groupon is today. So you got a lot of retailers. And then tomorrow you've got Advanced Auto Parts, Umbrella, you've got AutoZone, you've got Blink, you've got Builder Resources. That's coming tomorrow. First Solar's coming tomorrow. HP's coming tomorrow. Smuckers is tomorrow. Monster Beverages tomorrow. On Wednesday, you've got Dollar Tree, one of my favorite stocks. So there's a lot of goodies on the table right now, and there's a lot of things we have to keep in mind. So it'll be a very, 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 very interesting week indeed. Now, in terms of Fed data, let me just kind of bring this to your attention. In terms of Fed data, you've got the ISM Manufacturing Index. Today, you've got durable goods, pending home sales. Tomorrow, you've got international trades of goods and services. There's a lot of Fed data. But the most important factor is going to be earnings and the bond market. Now, notice the bond market's coming down a little bit. If it goes down and just bottoms out over here and starts coming up, that'll give relief to a lot of the tech and earnings plays, a lot of the retail plays that are in fact coming out with earnings. So be very, 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 very mindful that the fact that the bond market could in fact turn around. And as a matter of fact, I'm going to be looking for clues for the bond market to turn around to see if the market stabilizes or not, or continues down this route. So today you're going to have a lot of data. On Wednesday you have a lot of data. And tomorrow you have international trades and goods and services. That'll be very interesting. And consumer confidence. There it is. Now, consumer confidence is really important when it comes to retail. Okay. So don't think this number is not. It's really, really important. It could be very, very meaningful. So pay very close attention to this number indeed. Now, let's take a look at the news. And let's look at global economy a little bit and see what we can expect. So U.S. benchmark indices closed lower on Friday as a stronger than expected U.S. economic data fueled expectations of more aggressive rate hikes from the Federal Reserve. Friday's session major indices. Now look at this here. Biggest weekly drop of 2023. S&P dropping 5-week low, Dow shedding to a 2-month low, and NASDAQ falling to a 4-week low. Typically, now remember what I always say, markets are mean reverting. So typically, usually, under most circumstances, you would see upside as a result after that. But we've been hit hard. I mean, really, really hard. And I wouldn't be surprised if we started backing off and would come back up all the way from the 32,800 level all the way to the 34,000 level. It doesn't really mean much. It's just a consolidation, but that's what the market's going for. And I remember warning people that the stock market the broad stock market may start looking a lot more like this. Let me show you. Choppy. Remember, small caps are choppy, and they started being choppy a lot earlier, which means we could be seeing the same thing in the Dow. Remember, small caps give us the first idea or the first scenarios of what's to expect. And we still haven't seen a breakout yet, but at the same time, I'm not really seeing ARK break down too much. All right, just kind of sitting there in between. And it wasn't reactive very much with this Michigas, all this craziness that happened last week. Now, data on Friday showed core PCE index, which is the Fed's preferred gauge of inflation. It stood at 0.6% month over month, 4.7% year over year, stronger than expected, adding to worries that the Fed may have to keep rates higher for a longer period of time. U.S. personal spending demonstrated the biggest increase in 1 3/4 years, jumping 1.8% in January compared to expectations. University of Michigan Consumer Sentiment Index rose to 13-month high of 67 in February. Now, this is where I want you guys to pay attention to. Please, please, please listen and listen good. Because they're telling us the truth. See, they weren't for a while, but now they are. Cleveland President Loretta Mester said Friday that inflation remains too high, and the Federal Reserve will need to bring interest rates above 5% to tame inflation. What did I say? 5.2 to 5.4. Boston Fed President Susan Collins said that more interest rate hikes are required to curb too high of inflation. I anticipate further increase to reach sufficiently restrictive levels and then holding there for some time. Collins said, Jefferson said, the ongoing imbalance between the supply and demand for labor combined with a large share of labor costs and services suggests that high inflation may come down only slowly. So if you're just listening to what they're saying, now notice Powell's not in my rhetoric. That's because I'm not listening to anything, Mr. I'm not going to be honest with you till you reappoint me. Powell, he's very Weasley. Squirrely. He's squirrely. So 0.25 rate hike, 73.8%. 2.6, 50 basis points. So far, we're going 2.5, and I'm pretty confident it's going to be 2.5. Earnings front, as I mentioned, Target, Dollar Tree, Lowe's, Macy's, Best Buy. Oh, I didn't even know Best Buy's was on the list. Costco, they're set to report this week, and if you ask me nicely, I'll send you this list. Actually, you know what? I'll put it in the Telegram channel for everybody. That's what I'll do. Yeah, I'll go ahead and I'll put it in the Telegram channel for you guys, so you guys can get your grubby paws on it. All right. All eyes are on U.S. core data orders today in a couple of hours. Economists forecast January durable good orders to be just a little bit higher. U.S. durable good orders data will be reported today. I'm more concerned with this report right here. Let me show you. Consumer confidence. That's really, really where the money is right now. Let me go ahead and finish this. Now, Chinese composite today closed lower as uncertainty over forthcoming Chinese economic data weighed on sentiment. And in terms of earnings or pre-market watches, SGen is up 12%. Twilio is up 1%. Lee Motors is up 5%. And Sono is down 1%. So that's where we're at right now. Now, again, keep your eye on the bond market. If you see the bond market breaking down, like really, really breaking down, there's a good chance it'll impact the stock market. But as I said, that things are not looking all that bad. Now, let's look at sectors real quick. Let's take a look-see and see what's going on here and see if they've been correcting themselves. Now, remember what I told you last week? I said there's no way in living hell that communication services is going to stay up and all of the three sectors are going to come together. Well, let's take a look-see here. Let me show you a week ago. Actually, 2 weeks ago. Let's see, 1 week ago. Let's go back another week. Technology, communication, consumer discretionary. That's February 9th. 1 week ago, 1 week ago, communication, technology, consumer discretionary. Now, today, communication services, technology, consumer discretionary. How long ago did I tell you that was going to happen? And now you still have consumer staples in the mix. These three should be next to each other. Honestly, they should be all the way down here, but I digress. The point is, now communication services, technology, and consumer discretionary are much, much closer to each other, and you're starting to see financials, industrial, basic materials, and energy lead. And don't you dare write energies off, because I'm telling you, they're not done yet. They're not done yet. Matter of fact, if you look at the energy sector right here, if this thing ever turns for me, Let's do this here. There we go. Yeah, if you look at the energy sector, let's look at it on a period here. It looks like it's hitting the 200-day moving average, and it looks like it wants to bounce back up. Typically, what you see is you see a swing high, price action consolidate between the 50 and the 200-day moving average, and then come back up. And I think we may be seeing it because I think if we were going to go lower, I think we would have already gone lower, especially with what we saw last week. Now, in terms of action plan, that's the most important thing we need to talk about, the action plan. Be careful. Be very, 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 very careful. If earnings start slipping, all right, you're going to see the bond market start moving lower. If the bond market starts moving lower, or you see aggressive selling pressure in the communication technology, that's going to be a problem. I'm actually expecting a nice little rebound from those sectors. So it'll be very interesting to see when we get it, how we get it, and how it's going to impact the market. But for now, be very cautious with communication technology and consumer discretionary. This is one of those times you want to start looking at the best stock and not the best sector, because sometimes, especially right now, you can have a couple of stocks in each sector that are doing really, really, really well, and then the rest are doing really bad. So this is not a time to be very broad. This is a time to be nimble and be very, 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 very selective. Now, folks, before I let you go, this week is going to be very dangerous. Let me give you some levels on the SPY. Pay attention to these levels. These are important levels. All right, notice we bottomed at right at the 200-day moving average. Here's what I think is going to happen. I think we're going to go back to this top. See how it broke down right here? I think we're going to go back to this top and we're going to continue gyrating. If we break this 200-day line, which we're sitting at right now, it ain't going to be pretty. Don't think it's going to happen today right now. So far, earnings are looking better than expected. So far, for this week in terms of retail. So I'm expecting the S&P to come back into this channel. QQQ, notice the QQQ did not break that channel, and now it's looking a little higher. Let's go ahead and put that here. I think we're going to come back up to this channel. Whether we're going to break this channel out, I'm very skeptical on, like really, really skeptical on. And if you look at the semiconductors, which are which were looking pretty good, they're actually bucking the trend completely and are staying above the 200-day moving average. So be very, very cautious. Keep your eye on the bond market, and also keep your eye on whether communication technology and consumer discretionary are consolidating or if they're expanding back up. Now, here's what you need to know. Folks, trillions of dollars are fleeing the stock market and flooding into high-yield savings accounts. It's true. I mean, look at what I just said here a minute ago. Look at this. Where's my weekly review? I was just showing you how here. Look at this. Here, I'll prove it to you. S&P dropping to a 5-week low, Dow shedding to a 2-week low, and Nasdaq falling to a 4-week low. That confirms what I'm saying right now. Trillions of dollars are fleeing the market. But this could be a huge mistake. Inflation was at 6.5% at the beginning of the year. But even the best high-yield saving accounts only pay 3 to 4%. That's why former hedge fund manager and 35-year veteran Jack Carter created a new strategy. It's a way to target potential extra income in the stock market each and every week with a 97% win rate. Click the link below. Watch Jack's presentation. Do it now. Don't delay. Don't procrastinate. And if you can't find a link, it's below this video in the Wealth Press YouTube channel. Like us, subscribe to us, and have a fantastic day. And I'll talk to you guys real soon.